But we're fortunate to have JD Davids with us tonight. JD is a software company founder with over 30 years of experience building startup companies in California and other areas of the country. He has served on the management teams of 8 different companies and 6 successful exits, and he's completed over $1 billion in deals. In addition to his operating experience, his SmartMoney Ventures education program, where he works now as managing partner, has had over 3,500 participants nationwide and 40 graduate companies raising over $260 million just in the last 5 years. And he's presented these programs across the country from Boston to San Diego and places in between. He is a graduate of the Ohio State University Honors Accounting Program, and he's a United States Marine Corps veteran. He was awarded the Best Advocate for Veteran Entrepreneurs by the San Diego Business Journal, and he received congressional recognition for his Startup Battlefield 101 certificate course, which was in partnership with UC San Diego. This program trained veterans just like you entering the private sector on how to view entrepreneurship with a lens of the kind of battlefield programming and campaign planning that many of us are familiar with in the military. As I mentioned, he currently serves as the managing partner of SmartMoney Ventures. And please join me in welcoming JD for you tonight.
Awesome. Thanks very much, Mike, and welcome everybody. Good to connect with you again. I was on the call when you had the original introduction, but it's great to see you all, and I really look forward to talking with you interactively about entrepreneurship and the direction that you want to take your careers. Real quick, the rules of engagement. If you could have your video on and your audio off, that would be great. If you could silence your cell phones to minimize distractions and distractions, that would be great. But I do invite you to ask questions throughout. This is intended to be an interactive session. I do have a lot of content that I'll want to get through, but in order to manage that, if you could just do a direct chat with Mike, the moderator, and then he'll sort of decide how to filter in the right questions, because we do have set aside generous Q&A at the end. So if there's something that I can answer quickly while we go along, that's great. If I want to bump it to the parking lot and get to the Q&A session, we can do that as well. And of course, the slides will be available afterwards. As Mike mentioned, this is the first of 3 entrepreneurship sessions. So we'll be, did I do that? Okay. Demystifying entrepreneurship is today. Then on December 5th, I'll be teaching again on veterans and entrepreneurship. And then on February 15th, I think Brett's going to be teaching on connecting with resources, and it'll be the year-end forum towards the end of May as well. So the topics that we're going to cover today include, the first question is, why entrepreneurship? And thank you for those of you that filled out the surveys that I sent out. Great to get a little flavor of where you want to take your career, so I can sort of tailor what we talk about to the audience. We're going to talk about a few successful veteran entrepreneurs and a couple of surprises that you may not know. People that are successful in the business world that you would recognize their names. You might be surprised to learn that they are actually veterans. Talk a little bit about the entrepreneur journey. We're going to talk about different types of entrepreneurs. We're going to talk about different financing sources, and we're going to talk about venture capital. So we'll give you guys a complete MBA in 60 minutes or less. How's that? A little Q&A session at the end. So the first topic is really about, why do people want to be entrepreneurs? And a lot of the answers that I typically get, and some that I got from y'all in the last week, first of all, is sort of the independence to be your own boss. Obviously, there can be financial rewards. There can also be big financial risks, which I felt both sides of that. You want to serve a certain group of customers that you may have a relationship with or want to have relationships with, to innovate and disrupt markets with technology, and impact, solving problems in the workplace. Most of the time, entrepreneurs, when you ask them, tell me the story of how the idea came about, it was typically about a problem that they had encountered somewhere in their work or in their life. And also, a lot of people want to get into entrepreneurship to make a difference. Somebody in our group wants to provide legal services to veterans at an affordable price. And I think that's a fantastic thing. So there's a variety of reasons that people pursue entrepreneurship. But what I will tell you is that once you catch the bug, it's almost impossible to shake. It's an addiction. And I think the most important thing that I always encourage entrepreneurs early in their careers is to have a compelling why for what you're doing. It helps a lot to make it through the hills and the valleys if you have some sort of higher purpose. And it's really important to delineate specifically who it is you want to help. Focus on the customer first and the problem first. And that will put you way ahead of a lot of people that focus perhaps a little bit too much on their product. Why do you want to help that group of customers? How do you want to help those group of customers? And then you have to come up with a compelling value proposition to sort of support all of those pillars together. And the reason that meaning is so important is because in order to innovate successfully, you're going to need resources. You're going to need to build what I call a tribe of supporters. I frequently say that one man does not a company make, one person, one woman does not a company make. You need a tribe of people to support your business. And I think the number one difference, whether you're in the reserves or have spent time on active duty and are coming back into the civilian world, is the number one difference is that civilians choose their missions. When we're in the military, our missions are defined for us largely. If you can choose your mission, that means your employees can choose your mission, can choose their mission also, and they can choose to say no. That doesn't happen in the military, so you have to influence them. And that means that the meaning, the why behind it does matter. You should expect to have limited resources. Oftentimes in the military, if we don't have resources, we can requisition them and we'll end up with them. But many times in the battlefield, we often work with limited resources, of course, but I think it's even more true in the startup world because actually part of it, what is a great hallmark of a good entrepreneur is that being resourceful and scrappy is the key to success. And sometimes if you're early in your process, you may be able to get people to work for free or cheap or for stock. And again, if you have a compelling why, that's why the meaning is so important. And right now, as you probably know in the news, there's a big competition for talent right now. I mean, gosh, how many retail establishments have you been into in the last month that were understaffed, right? The same is true in the innovation industry and across all industry sectors. So if you're going to compete for talent, it helps a lot if you know the meaning and the why behind what you're doing, because it makes it more compelling when you're trying to recruit people onto your team. So any thoughts or questions on that? I'm just going to open it up real quick on why you want to be an entrepreneur, how meaning is important. Just pause real quick, see if there's anything you wanted to bring out about that section. If not, we can dive right on into the next one because we do have a lot of material to cover. So as I mentioned, successful veteran entrepreneurs. Some of these people I was a little bit surprised about. There's an entrepreneur from Seattle, Nike shoes, started by Phil Knight. I didn't know this until last week, but Phil Knight was active duty in the Army for 1 year, and he served in the Army Reserves for another 7 years while he was in college. After he came back from Vietnam, he did serve in Vietnam. Fred Smith, the founder of Federal Express, FedEx, he's a military veteran as well. Bob Parsons, the CEO of GoDaddy, very famous company, of course, and of course their ads about their marketing department are infamous, right? The founder of Enterprise Rent-A-Car, Jack Taylor, was a F4 pilot, and he earned 2 distinguished service crosses as well. So impressive stuff. The guy who is Gordon Logan is the founder of Sport Clips. Somebody mentioned in the survey that they're interested in franchising businesses. It's interesting because he got into the franchising business under another umbrella, and then he started his own franchise. So that was pretty cool. There's a company called ID.me, and if you've ever gone into the VA healthcare system, you probably use this to identify yourself. Well, Blake Hall started the company originally as something called Troop identification or something like that. Troop Trek. He got it launched off the ground, and now he's raised over $400 million for the company from really high profile investors, including SoftBank. Damian Patton, Banjo is a technology company where he has raised over $120 million in venture capital. He was an OS2 in the Navy, a NASCAR crew chief. He got his degree at University of North Carolina, Greensboro, went to MIT, and he also has very high profile investors. So the reason I share some of these examples is because I want to encourage you. It is not only possible, it's actually common. My business partner at SmartMoney Ventures, Dave Burkus, he's probably one of the most famous angel investors in the United States. He was a former P3 crew member in the Navy Reserve, an air intelligence officer, and he was the founder of Hotel Lodging Systems, which was actually the very first software system where you could go online and book a hotel room with a computer. He was the founder of that company. He grew it, took it successful with an IPO. It was an Inc. 500 fastest growing company, and he will tell you that he made an obscene amount of money from that. And he turned around and decided that he wanted to take a big chunk of it and reinvest it in younger entrepreneurs. So he and 4 other people got together and formed something called the Tech Coast Angels, which is currently the most active angel investment group in the country. They're based in Southern California. He was one of the first 5 founders. He was chairman emeritus of that. He's done over 200 deals himself. He's also managed 350 deals on behalf of Tech Coast Angels and their 3 funds, and he's published 15 books. And so I'm hoping that sometime in our future, you'll be able to hear from Dave as well, because he's got some amazing stories about entrepreneurship. A few other companies there, Bayliner Boats, MGM Studios. Again, we'll send this out, but I was impressed to see how many entrepreneurs there are that just happen to be veterans. It's exciting to know that we're all in good company. I'm going to pause there. Does anybody else have any other examples that I didn't have on the list?
The founder of Big Lots is a veteran and the current CEO, and we've had him come speak to previous class too. So
that's excellent. So the journey of an entrepreneur is definitely an interesting one, no doubt, because we all come up with a plan, and we have the resources, and we know how it's going to happen, and we plan everything out, and we got our strategic plan and our tactics plan and our communications plan and all that kind of stuff. But in reality, it looks a lot like this. You have a lot of high highs, you have a lot of low lows, and that's the cost benefit, really. The stability of being in a paying job and in the military, that's one thing we don't have to worry about. You're always going to get your paycheck, you're always going to have your health care, you're always going to have food and a roof over your head. When you're an entrepreneur, not all of those are givens. You could be really, really high one day and really, really low. And I can tell you, I've done a lot of deals that were successful, and I've done a lot of deals that were painful as well. And I'm going to share a couple of, actually one specific example on that. But this is from various research services, including Harvard Business School. 95% of startup companies fall short of meeting your revenue projections. Well, that's not a surprise. 80% fail to produce returns on investment. Now, that's a problem, because if you have a water faucet of investors that are putting money into a pipeline and it's losing 80% of the time, there's no guarantee that faucet will remain open. And so the best thing you can do is make sure that you're just as focused on return on investment as your investors are, and have those conversations frequently in your board meetings and offline conversations as well. 40% of the time you lose everything. And 99% of the reason is lack of planning and experience. Most of the time, unfortunately for funded startups, there is no market need for the product, meaning that they spend a lot of time building an awesome product. And it's not that it isn't a cool product. It's just that it's a lot more cool if you can sell 1 million units of it for some amount of money. So, and so we say, somewhere between 75 to 85% of startups fail. And I want to share a case in point. And it's kind of funny because, when I hear my introduction and everything, All of these things are true. I have been blessed with a lot of wonderful success and wonderful experience and some great relationships along the way. But I've also had some painful failures. In fact, the company that I was the founder of, Deal Management Systems, we actually lost everything on it because 9/11 happened and we were in the deal business. We processed over $1 billion in deals. But when the planes hit the towers, my business died 5 months later. It was a casualty. But the real story that I want to share with you is a company called vMix. I was the employee number 4. Our founder came out of mp3.com, which was a massive success in the digitizing audio business. And our sales head and co-founder was also the sales there. We went out and decided that in, what year was it, 2005 or 2006, video is the next big thing on the internet. And so we went out and raised a Series A round of $5 million. And about the same time, a little company called YouTube up in San Francisco raised a Series A round of $3.5 million as well. And we thought, oh, that's awesome. You know, that we're in a foot race to dominate video on the internet. And we raised more money than they did. And these were the traffic stats for the first 9 months after that financing round. And so we were neck and neck, vMix and YouTube. Fast forward the tape 11 months later, they get acquired by Google for $1.6 billion. 11 months after a $3.5 million Series A. And it was interesting because we had really good investors. Enterprise Partners Venture Capital was our lead. They managed $650 million in assets. They've made 118 investments and 31 exits. These guys are not amateurs. They know what they're doing. And they were experts at enterprise software, meaning selling software into companies to manage accounting, HR, finance, all that kind of stuff, right? But they didn't really know the consumer internet business as well as a company called Sequoia Capital up in San Francisco. Sequoia had funded Google. And so the partners at Sequoia and the CEO at Google were best buddies because they made a boatload of money on the IPO for Google. And so basically the difference here was that Sequoia had the relationships to march YouTube into Google's office and say to the CEO, hey, video is the next big thing. You need to buy this company. The price is $1.6 billion. And, you know, by the way, we've already made a bunch of money together. And so the illustration here is that it's really important who your investors are. Select your investors very carefully because you could potentially end up with a situation where your competitor gets a $1.65 billion exit. And to fill in the blanks, if you fast forward the tape, we continued raising money. Over time, we raised $30 million and we almost sold the company to GoPro. A month before GoPro went public, we had a term sheet signed for them to buy our company and we were getting pre-IPO stock in GoPro. And then a week before the IPO happened, the market went sideways. And so they had to pull it. And the CFO said, all deals that are pending are off indefinitely. And the company closed 60 days later. And so the difference between having the right investor and the wrong investor is the difference between a $1.6 billion exit and what turned out to be a $30 million hole in the ground for all of our investors, and all of our stock options were worth zero. So I don't usually like to tell that story, but I think it's important to tell that story because who you select along the way as your investors, your partners, your employers, your co-founders is really, really important. If there's one thing that I can tell you, if you're going to raise money, don't just raise money, get smart money, get money that can take you to the next level and catapult you ahead. Any questions or comments on that?
JD, we have a question in the chat, and it's concerning success and business plans. And it says, is a business plan a reliable way to reduce the chance of failure? Textbooks always say to do a business plan, and said right before they say the plan will work, right up until the first bullet goes by the entrepreneur's head. So in the real world, how effective is a business plan?
So much like in the military where we have strategic planning and tactical planning tools, like BAMSys and a variety of other, column formations and all these types of, we have a playbook of things that we use for strategic planning and tactics, right? Same thing is true in business. The value of the business plan is not the 50-page PDF that ends up in the bottom of the drawer 2 weeks later after you publish it. The value of a business plan is the process that you go through and the questions you ask yourself and your co-founders and your team. What are our strengths and weaknesses? What are competitors' strengths and weaknesses? What's our angle of attack, right? So it's not the plan itself that matters. It's the process that you go through and the refining of your tactics and strategies. So the tools that I particularly like to use is something called the business model canvas, which outlines, your customers, your activities, your prices, all that kind of stuff. That's one strategic planning tool. There's the EOS model. There's a book called Traction, and I'm a big fan of it. But they have the Entrepreneur Operating System as another framework. There's the typical SWOT analysis, strengths, weaknesses, opportunities, and threats, and a whole bunch of others. And I'm not going to be prescriptive about what tool you should and shouldn't use. What I will say is all these tools are at the ready, and you should utilize them to the degree that you get a cost benefit out of the time you invest in doing it. But most of the time, I like to measure twice and cut once.
Great question, Andy.
Yeah, that was a terrific question. All right, so now let's talk about types of entrepreneurs. And this is fun to sort of unpack because it's a little bit new to take a look at this. So some people want to be a small business owner and have basically maintained primary ownership of the business. And it may get, so big, but we're going to talk about what the revenue sizes of some of these companies are. Some people want to be franchise owners. Some people want to be in real estate businesses. I know a lot of veteran friends of mine, and you probably know them as well. When they were stationed in San Diego at Camp Pendleton, they picked up a couple of rental properties out there and started renting them, to the young enlisted people. Okay, that's a pretty steady stream of cash flow, and then they go to Virginia and they buy one over there. And I know a lot of people that do that, and that's a very specific small business, and it's a decision. And if you want to go do that, then don't waste your time talking about venture capital and all this other kind of stuff. Know what you want and know what your path is, and go to those resources, because there are people that know that I could send you to them, but I'm not the real estate guy. Some people want to be a DoD contractor. You've built a lot of relationships while you were in the military, whether it was active or reserve, and there be particularly on the logistics side. I know that there's a lot of interface between the military and the commercial. So relationships oftentimes open up opportunities for you to potentially provide services back to the DoD. That's not a difficult transition. But then the last category on the right-hand side is what I call hyper-growth startup. And that means that the company is going to grow so fast that you're going to have to raise money from outside investors. Otherwise, your competitors are going to zoom past you. And usually what we talk about there is for an investable company. Most of them are what we call STEM businesses: science, technology, engineering, and mathematics. Usually it's a product that can be patented. Not always. Sometimes there are, companies like Facebook, right? Nothing's patented about that, and it was certainly hyper growth. But in general, there's technology involved, and it certainly is there. And I also want to open up the door that if you want to go down the hyper growth startup path, you don't have to say, okay, well, I'm going to go be a founder or a co-founder in a company. You can actually go join an existing team of people, or a team of people that are forming, because I think a ton of people that are military veterans would make great and fantastic chief operating officers for a lot of these internet companies that need planning, discipline, execution, because most entrepreneurs like myself that I know, we do a lot of activity, but we sure need a right-hand person to keep everything on track and make the train roll on time.
JD, would you also say that there's some overlap here too? I mean, I personally know a lot of people that have started companies that are DoD contractors, but
Absolutely.
They found a niche that when they were in the military said, boy, if we had this, and they went out and invented this and then sold it back to the government and did it that way.
Absolutely. That's actually a fantastic way to build a business is first identify the customer and the product that they need and the problem they're trying to solve, and then go out and only raise the money that you need to make it grow faster than you could without it. That's the distinction that I want to make between all of the categories on the left and the hyper-growth startups where you're going to raise money. You should only raise the amount of money you need so that you can grow faster. I think a lot of people get excited about venture capital, and it's just like anything else. You have to use the right tool for the right job. Here are just a few examples of small business owners, different categories that I've seen people go into. Some of the different franchises that are out there: UPS, Sport Clips, Subway. Everybody recognizes those names. DoD contractors. So there's just a ton of people in logistics and transportation because that's a great area of expertise. But I created this grid that will help you sort of understand this. And I will definitely make these slides available afterwards. But the different pathway that you choose is going to produce a very different business model and a very different lifestyle for you as an entrepreneur. And so it's important to know what the pathway looks like. And to be fair, the first three columns, are very similar to one another, and the hypergrowth startup is unique. But I think the biggest difference between an investable business and one that's a small business is the revenue size and how fast you get there. If you start a business and you're going to, start earning a few $100,000 a year, that's fantastic. Go do that. You will have independence. You will have income. You will have, if you're doing it right, you'll have cash profitability. You'll own 100% of the company. You probably won't have an outside board of directors, but it is unlikely that after 10 years, your revenues would be above $20 million in revenue. It can happen, but just in general, that's kind of how it works. Same thing with franchise. There's probably for each location that you own, say a Subway franchise, there's probably a fixed amount of revenue that you can earn per store, your average revenues per store. But it will be very predictable. And if you like predictability and you have young children and you want to build up a college fund for them, then these are pathways that you might consider. And the real estate kind of falls into that as well. But I want to draw your attention to the column on the right, which is where I've lived most of my career. It's fast and it's fun, but it's risky. So, and you have to have a stomach for it. You're going to grow your company to at least $50 million in revenue, but as high as 100 million or more in annualized revenue in 3 to 5 years. It's riding a rocket ship. You're going to raise money from outside investors. It's a high risk, high reward sector. And if you don't have an appetite for that, and you don't have a family risk profile that's appropriate for that, then you might want to consider one of the other ones. The metrics that are important, you notice the 3 on the left. It's important to be profitable. It's important to keep your customers. You want predictability. The growth rate is not so important there, right? But in the hyper-growth startup world, absolute top-line revenue growth is the number one thing, because your valuation is dependent upon revenue growth, and that's why the investors are throwing money at you. The difference is then, you're going to have a team of founders. You're going to eventually have a board of directors of maybe 3, 5, 7 people over time. And if you look at the line at the bottom, what does the CEO's life look like? Well, if you think that becoming an entrepreneur means that you're not going to have a boss, that's just not true. You're going to have more bosses than anybody else. You have customers who are your bosses because they write the checks. You're going to have employees that report to you, and you'll quickly learn that you actually report to them because you're trying to enable them to do the job that you've given them. And you have to learn a little bit of accounting. You don't have to be an accountant, but you need to know how to read a financial statement and look at cash profitability. And in a hyper growth startup, you have all of those plus investors and board members. So it's kind of like the more you get promoted in the military, the bigger the net of people that you're responsible for. And feel free to jump in with any questions. But the other thing to look at on this particular slide, talking about the mission, excuse me, the mission of the hypergrowth startup is to innovate at large scale and to transform industries. The mission of most small businesses are income for the founder, independence, and financial stability. But I also want to draw your attention to the middle, where it says the number of employees. Small businesses can go from 1 to 25 to 50 employees, but a hypergrowth startup will go through that. They'll blow right through that in the first year or two and start in the hundreds and thousands of employees. So it's a fast pace, you experiment a lot, you learn on the fly. It's actually very much like building your strategic plan for the battlefield. And when the first bullet flies, everything changes. But the benefit of that planning is that you now have the information in your head that allows you to iterate and adapt on the fly. So the planning process has value, but the document is not the one that has the value. I'm going to pause there and see if there's any questions or comments.
Yeah, JD, we do have a couple. One is relating to, you mentioned you thought joining some startups is a good place for veterans. Are there places to go to find those startups that are looking for people, like websites or hiring mediums, or is it more based on relationships and networking only?
It's a little bit of both, but I'll tell you one website off the top of my head is called purposejobs.com. And it is focused on all kinds of startups in the Midwest region of the United States. And they have basically a job board. And you can, with advanced search, you can go and say, okay, I know Python programming and R programming, and I want to live in one of these 3 cities. That's the first one that comes to mind. And if I think about it some more after our session, I could probably come up with some other ones.
And we have one more question. It says, when you're looking at risk for startups, are there any key things that make you say yes or make you say no and walk away?
Sure, absolutely. So investors typically assess risk in a startup in 3 buckets. The first bucket is market risk. If the founder says, I want to raise $5 million, how big is the market for that product? And do I think it's big enough that we can carve out our niche and achieve the hockey stick revenue growth that you have on your slide? Is the market big enough? And is there an opening in the market, a disruption where we think we can capture a certain amount of market share? Once an investor believes that is this a problem we're solving? Is it a big enough problem to solve? Will we get a return on our investment? Once they get through that gate, you go to the technology risk. Are we doing cold fusion, or is it a new graphic database, right? How complex is the technology? This is where venture capitalists are experts at assessing the technology risk. Okay, the entrepreneur says it's going to take $1 million in 9 months to build this platform, right? They've never done it before, so I'm going to double the budget and double the time, right? But how realistic are how realistic is the whole thing? This is the technology that they think they're going to need. This is the problem that they're solving. We're going to have some reserves on the back end, but their assessment of technology risk. Once you get through that that second gate, so market risk, technology risk, the last one is execution risk. If I buy that this is a problem we're solving and it's a big enough market that we can carve out our niche, and I believe that we can build the technology and make it happen with a reasonable amount of money and time, is this the team that can make it to the Super Bowl and deliver? Because every startup pitch deck has a ridiculous hockey stick revenue growth. And what we typically do is we'll poke around and say, okay, well, let's look at 18 months out. How many units are you going to ship, right? And how many salespeople do you need? And how are you going to produce that? Where's the raw materials? Or if it's a website, right? How many daily active users do you need? What is the average length of their visit need to be? How many clicks do we need? What's our conversion ratio, right? There's metrics around that. And the way that we assess execution risk is not just the personality of the founder, but how much thinking have they done around the equation that's going to drive the hockey stick revenue growth. And I think a lot of it really does come down to personality. How do you make decisions? How do you deal with adversity? And you'll often find that investors will ask what may seem like oddball curve questions, but they're trying to understand how you think through problems. Because if they write $1 million check, they're going to come from this side of the table onto this side of the table and sit next to you. And they need to understand how you're going to make decisions, that they can trust you. and that you're going to share information appropriately and raise your hand when you need help, and ask for more resources. That third bucket of execution risk is the hardest one to measure. But I'll tell you, the quickest way to get an investor to not return your calls is to just not be yourself. Just be yourself. If you don't know the answer, tell them, okay, well, I don't know the answer to that, but here's how I would think about this, and here's where I'd go, and here's the person that I would call to get an answer to that question. They just want to know that you're thinking through things. The quickest thing to turn off an investor is if you get defensive or you try to BS your way through it. But all of us in this room as military veterans, you know how to smell BS. And that's probably one of the biggest filters.
We got
JD?
one more question, JD, if you got time.
Go for it.
Are you familiar with any nonprofits that have followed the hypergrowth startup model, or does that ever happen?
Nonprofit. Yeah, Kiva, Kiva. They do microloans all around the world. So if a single mother in Zimbabwe needs a $350 loan to open a grocery store in her village, you can go online and do it with 10 of your friends. Kiva, Kiva.org. That's the only one that comes to mind. I'm sure with more time I could come up with others, but yes, it is fairly rare. All right, so innovation career tracks. Also, as you are students, it is very common for universities to have a small batch of startups that are in their President's Buckeye Accelerator, or whatever it is. If you ask around your college, you'll find the entrepreneurs. Many of them are looking for interns and apprentices, and that is a fantastic way to dip your toe in the water. But the number one thing is to really know what your personal strengths are and where you can plug in and add value, regardless of your aspirations to be a small business or real estate or a franchise or DoD or hypergrowth. Know what your unique values and strengths are. One of the useful tools for me was the Clifton Strengths Finder. And I took this in 2012, and it absolutely changed the direction of my career. It's one of the reasons that I'm sitting here, because at that time I was like, yep, I'm a deal guy, I'm a finance guy, I'm a startup guy, I'm a software guy. That's what I do, right? But what I learned was I'm actually a teacher and a journalist and a podcaster. And I love hearing other people's stories and telling stories. And I learned that from the Strengths Finder. Now, of course, there's Myers-Briggs and disc analysis and the anagrams and all that. So I don't really care what flavor you choose. My encouragement to you is just to know yourself and your strengths and how you can plug in and add the most value. So if you are going to launch a business, regardless of which lane you choose to run in, it's important to know what the market desirability is, the technical feasibility, the business validation. These are the things that we just talked about. But as Scott shared this with me, there's a Harvard Business Review article called How to Win. And it's interesting how this lines up with the way most investors assess risk, because obviously this correlates exactly with what we were talking about. So let's talk about the fun stuff, funding sources. So not all businesses need funding, but if you do, it's important to understand, again, use the right tool for the right job. For example, if our target was a small house in a potentially civilian area, we're not going to use a cluster bomb. We're going to use a laser guided missile with a very small footprint, right? And if we use a cluster bomb, there's going to be problems, right? So same thing here. Don't get caught up in the whole, let's raise venture capital and raise money from investors. Know what your financing needs are and get the right financing to match up with what that need is. Most times when you start, you're going to bootstrap, which just basically means it's all coming out of your pocket. Founder investment, your personal savings. I've gotten out my credit card more times than I can count. I've gotten personal bank lines of credit. But where you want to really land, regardless of which of those paths we looked at, get to the point where customers are writing you more checks than investors are. The quicker you can do that, the better your life is going to be. And I actually, when I started my business, it's interesting. I went out to customers and I got signed letters of intent that said that they would buy my product for $25,000 if I would just go out and build it. And I got 3 of those. And I entered a pitch fest competition and I gave my pitch. But then in the end, I said, I have 3 signed purchase orders from customers right here. And guess what? I got swamped at the end by investors. So that's the key to getting investors interested, is show them that the dogs are eating the dog food. The traditional rounds of fundraising, and this is usually for fast growing businesses, as we talked about, is angel investors, which are just simply individuals who have achieved a level of wealth that allows them to write checks to small startups and know that they're going to lose all of it potentially. The reason they can do that is because simple portfolio allocation says that in a high risk, high reward business, I only want to take 5% of my net worth, maybe 10% of my net worth, and put it in this highly risky category, because I could hit the lottery, but I could lose it all. So if you have a net worth of 50 million or $100 million, then you got $10 million of play money, right? 50 million, you got 5 million, right? And if you start divvying that up into $10,000, $25,000 checks, $50,000, $100,000 checks, it's kind of fun. And usually people who are angel investors are people who have had a successful life-changing event from a company that they sold, that they were the founder of. Those are usually the best investors because they understand what it's like to sit in your chair. Unfortunately, they do not have a mandate to invest, so they can be very frustrating to get across the finish line to actually write the check, as opposed to having meetings with you for 6 months and telling you all the ways you should change your pitch deck. So avoid that. Venture capital investors are institutional investors who actually have a mandate to invest other people's money that are in their fund, and therefore their bar for due diligence is higher. However, they do have a mandate to invest. If you have a $100 million venture capital fund, you do not have the option to say, no, I'm not going to write any checks this quarter. You do have to deploy that money, otherwise you don't get your fees. So that's the main difference between angels and VCs. Angels can walk away and say, I don't feel like doing a deal this month. And VCs have to put their money out there. It's just a matter of, are they going to put it in your deal or somebody else's? Corporate venture capital is basically the same thing as venture capital, except it's under the umbrella of a corporation. For example, Google, big giant corporation now, right? They have their own division that's called Capital G. That's Google's venture capital unit. They behave very much like venture capital investors, although they typically will have a more strategic, narrow window that says, well, we only invest in companies that are doing this type of stuff. And right now, the hot sector that everybody wants to put money into, including Google venture capital, is artificial intelligence. But that's a different topic for another day, but plant that seed there. Obviously, if you have revenues and you're growing and you have outside investors, you can get bank loans. There's also something called venture debt. The way that works is if you raise $5 million from a name venture capital firm, mostly there's 10 firms out there that will say, okay, well, we'll give you $1 million in venture debt alongside of that. And you give them a little sweetener to do the deal. That's not uncommon. And, it used to be that all of the funding sources kind of stopped there. But in the last 10 years, there's all these other sources of funds. Pitch fest competitions used to just be, you got a piece of glass or something and you won. Well, now you can get $10,000, $20,000, $50,000 or some in-kind services from some lawyers and others. Incubators and accelerators are regularly writing checks. Now, angel investors, those individuals, they get together and form their groups, and then there's syndicates where they share deals. And so you want to kind of network your way into that. There's also family offices and foundations, and that's just basically, once again, an individual who has achieved a level of net worth that they actually have to hire people to manage their office. This would be like Mark Zuckerberg has a family office. Bill Gates has the Gates Foundation. It manages both their investments and their charitable operations as well. Government grants are becoming much more available now in a variety of different categories. And if you're around a university, there's definitely government grant money for research. There's also university gap funds. And more universities are creating these vehicles to take technology that is sitting and locked up inside the university and commercialize it. So there's new forms of financing available. And I think Mike might have a comment on that.
Yeah, I was going to say there's at least I know of 4 of your schools that are doing this. My guess is they may all be doing it. But talking to your entrepreneurial faculty lead, they will certainly know this. If there's anything, money available to do something, as well as what JD talked about earlier, there might be an apprenticeship or something that you can get involved with, a group that's going to be starting this process or is already down the road a little bit on this process. We're just seeing that a lot more at universities. And like I said, I know several of yours are doing it, and I expect that many of them are, if not all of them.
So my favorite deep dive is on venture capital because that's where I've lived most of my world. It's an exciting world. And I actually created a program previously called Startup Battlefield 101. I did it, and it was an 8-week certificate course in partnership with UC San Diego. And we trained veterans transitioning out of active duty. And I basically just mapped all this out in a simulated battlefield. So the whole name of the game, like, this is my way of explaining the monopoly game that is venture capital. So we'll give it a code name and we'll call it Operation Innovate, right? The mission objectives is you're going to launch product A, whatever your first product is. You want to sell and ship 1 million units of that product. You want to collect 10 million in revenue from customers. You're going to create about 150 jobs, and then you're going to sell the company for $100 million and give money back to your investors, give them a return on their investment. Your team will get stock options, and the whole process takes about 3 to 5 years. That's the whole mission in a nutshell. I often wish that people that teach entrepreneurship would teach the mission that simply in our terms as veterans. Like, we sort of, okay, I get it, right? It takes about 3 to 5 year mission, right? Launch a product, ship it, collect revenue, create jobs, sell the company. Awesome, I get it. And then you have to put together your tactical plan, again, using whatever flavor of planning resources you choose, but you definitely have to have a budget. You need a strike team, which is your founders, right? You need 2, 3, 4 people to go in and sort of land on the beachhead, if you will. You got to build your prototype of your your product, excuse me. You got to identify your high value targets, your HVTs, those are your customers. Who are the ones that are most likely to buy your product and pay the price that you want? But more importantly, who are the customers that are most likely to buy first? Because not everybody's an early adopter. You got to attack those initial customer targets, and your marketing campaign when you launch should be shock and awe. Then you need to go get your resources. So you need to go get a strike team. Then you got to go hire, some hardware engineers and software engineers. You need to raise $3 million in cash from investors. And the way that we declare mission accomplished is meet at the rally point and celebrate $100 million sale of the company. That's the whole game in a nutshell. Any questions or comments on that?
I had a question.
Please.
Where would you say you start this operation build? Do you start at mission accomplished and work your way back, or would you say you start at mission objective? Someone is like, for instance, someone had a passion project launch product A is their passion, or would you recommend, okay, that's great, but what's the end goal? What's the mission? What would you say?
Mission objective is to have a lot of customers for your product, or if it's a nonprofit, to have a lot of donors for your project and your campaign, and defining very specifically who those customers are or who those donors are, just like you would study a battlefield and identify where's the machine gun, when's the last time they dropped off supplies, how many people do they have over there and over there and over there, right? You map out who your most likely customers are that are going to buy your product, because your most powerful weapon as an entrepreneur is paying customers, or in the case of a passion project, donors. If there's one area, if there's one piece of advice that I always give to entrepreneurs is, don't over focus on your product and don't under focus on customers. Spend more time with customers than you do with anybody else, because they will inform your product development.
Thank you.
Andy, we had a question in the chat on, are there any personal traits with entrepreneurs that you find more compelling and indicative of success? So he said, for example, is honesty and diligence higher than a amenable personality, or are there things you look for in successful entrepreneurs?
A spirit of collaborative problem solving and a noted absence of what I call smartest person in the room syndrome. One thing that is the most important thing is that everybody, particularly on the founding team, can play well together with others in the same sandbox. It is the behavioral interactions between the founders over time that impact the success or failure of the mission and the company. I've literally seen companies that had outstanding products, great, brilliant engineers, outstanding investors, great team, but there was one person that had the smartest person in the room syndrome, and it ended up with, disputes end up becoming lawsuits, which ends up creating ugliness and a lot of time spent on things other than building the business. And so the number one trait is be able to play well in the same sandbox with other people and bring a spirit of collaborative problem solving, because the spirit of blame and whose fault it is and how we're going to make it right kind of stuff, that'll kill a company. That'll kill good companies. So that's the first thing. The second thing is persistence and grit. The ability to be resourceful, the ability to overcome obstacles, and the ability to get kicked in the teeth and get back up again day after day after day. You're going to get a lot of no's from investors. You're going to get a lot of no's from customers. But anybody that started a business will tell you that that's part of it. Is you have to have something inside of you, that eye of the tiger, that persistence, that grit, that commitment to mission, that's going to see you through those things. And if we rewind the tape to the beginning of the presentation, that's why knowing your why and the meaning and the purpose behind what you're doing, that is sort of the North Star that will guide you through. And then your persistence and grit and personality will get you through.
We have another question. I think you just kind of answered part of it right there in the last thing you said. It said, does this still apply to entrepreneurs that don't intend to sell? My program focuses on agriculture entrepreneurship, where the focus is more lifestyle-based rather than profit-based.
Well, so lifestyle-based versus profit-based. So there has to be a formula for financial sustainability of some sort. And whether that comes from donors or what have you. But so I would adjust the mission objectives a little bit, because typically what I'm hearing, most of the time you will have different metrics to measure your success. Your metric of success will likely be how many people that fit this profile have we helped, and how do we measure the way that we helped them, and how do we use that information to go back to the people who are paying the bills and incent them to continue paying the bills, so that you, even if profit isn't your motive, you do need financial sustainability and the cash flow to have the resources that you need in order to impact those people. Now, if it's a purely philanthropic thing and you don't need any cash flow, then your metrics of success would simply be how much time did you put in and how many people do you help. And that brings up a really good point, that there's a lot of times, a lot of people get excited about venture capital without understanding completely, is it the right tool for what they're doing? And so these are the reasons not to raise venture capital. If you don't need it, don't go for it. And don't sign up for the venture capital class unless you're just interested, because you might get sucked in with people romanticize venture capital, I think maybe a little bit too much. If you're not growing really, really fast, or you don't have the potential to grow really, really fast, you probably don't need investors. If you don't want a board of directors and people asking you questions about your strategic decisions and helping you make those decisions, you probably shouldn't raise money from outside investors. And if you don't ever want to sell your company, then you probably would either need to not raise money from investors, or cut a special deal with them that basically says, well, we're just going to repay the investment to you as a percentage of our revenues over time. That's a little bit more of a unique deal that you may sometimes see, but not that common. And then we're going to shift to Q&A, but there's one more thing that I want to share, and we're going to send this out afterwards, a take-home exercise. It's important to know yourself and know your personal family risk profile. We kind of mapped out a few different paths. It's important to map your path. I want to encourage you to seek and ask for advice and guidance. There's a great network here with the National Veterans Leadership Foundation and its broader network. But as you plan, I want to share this 5 whys that Scott Griffin and I were looking at. It comes from the Design Thinking Toolbox. And the 5 whys help you work through, and this might be a helpful tool for the person that was asking about the nonprofit thing. The 5 whys is a great framework of describing your problem and framing the problem, outlining what the direct impact of that problem is, understanding cause and effect, organizational hurdles, and system hurdles. And there's an entire framework that I am going to send you, and it is this sheet right here. So this is a great planning tool. And so I encourage you to look at this as a take-home exercise that we will email to you. You can kind of work through it and maybe write it up in whatever way is most helpful to you, probably in a Word document, and then give us some feedback on how helpful or not helpful that was. And I think that takes us right to Q&A at 7:58. I have plenty of time to.
We scheduled till 8, but JD and I will stay on as long as you all have questions and want to be here, but we want to be respectful of your time too. So it's over to you for questions, and please just unmute and ask questions.
JD?
Yes.
So I just want to comment. I think when you talked about, the different kind of categories, there's sometimes you may be working for a DoD contract, but there are civilian uses for the product, and then you can transfer over to a hyper company. The classic case in point was a company called ICQ. 2 tank commanders developed in the 1990s a way for tanks to communicate by sending messages back and forth because they couldn't hear. They got out of the military, created ICQ. ICQ sold to, I think it was AOL, and anybody who used an instant message a day, that's where it came from.
I love that story, Tom. Thanks for sharing it, because it's an important thing, particularly to the veteran community, is what we call dual use technology. I was actually on a steering committee for a group at UC San Diego, and a lot of retired admirals that live in San Diego. And it was all about dual use technology. To your point, I had a company that I worked with in San Diego that did exactly that. They took they were building heads-up displays for helicopters, and they licensed the technology to one of their other companies, and they made a little thing that bolts onto the side of your motorcycle helmet and does the heads-up display on the thing. There's a lot of investors out there that are looking for dual use technology. So I encourage you to email me any of those examples, because I have investors that are asking for that all the time. Because to your point, if you already know that the DoD, if it works, is going to buy X number of units, man, talk about de-risking a business. That'll get investors to write checks faster than anything I know. Anybody else?
Yeah, I had a question. Are you familiar with any models like the Newman's Own? Just like where they put all their profits into the foundation, or any like B Corps or anything like that?
Yeah, I love those. Thank you for asking that. And I did say thanks for filling out the questionnaire. So the company that comes to mind is Tom's. So they're a commercial company. Is it socks or anyway? Shoes. Yeah, they make shoes. So for every pair of shoes that you buy, they provide a pair of socks to homeless people in New York or something like that. I don't have that exactly right. That's one example. So Tom's. Another example is a friend of mine, Cody Barbeau. His company is called Trust and Will. And he just converted his C Corp after raising a whole bunch of money from investors. He just converted to a B Corp. And I'm fascinated by that. And so to explain what a B Corp is, it means that your board of directors has made an election to say that a C corporation, the board of directors has a fiduciary duty. They have a legal obligation to act in the financial best interests of the shareholders, the investors in the company. They are not allowed to do anything other than advancing the financial interests, the the value of the stock and the value of the profits in the company is the number one mandate. In a B corporation, you can carve out a specific mandate. The board of directors can do that without taking on legal liability. So like Tom's, they said, and you get to make it up, whatever it is, right? So every pair of shoes that gets sold, we're going to send one pair of socks. Okay, great. Then that's a carve out. And then everything else is under the fiduciary obligation to act in the best interest of the shareholders. And so it is a fascinating new area. I'm glad that you raised it. I think it's very popular now for obvious reasons. The idea of doing well and doing good at the same time is very popular. And one thing that I've seen a lot of my friends, technology executives, including myself, is that when we go to a nonprofit, we can take shares of stock and donate the shares of stock to the nonprofit, and then they can sell it. And what that does is I'm giving them something of great value, and at the same time, I don't have to pay the capital gains tax on it. So there are a lot of creative structures like that, and it's important. I'm glad you raised it. I think it's an important thing in today's business because I think, again, the ability to attract and retain employees often has a lot to do with the culture and how employees feel about your company and its mission and its impact on the world. So there's
another company, I think it's similar to Tom's. It's called Bombas for socks. And same thing. You buy a pair, they sell it, they give a pair kind of thing. And so that's how they started. I think they've now t-shirts and things like that, but it's absolutely what you just described as well.
Yeah, I think it's great to see that, and I encourage more of it. Any other questions?
I had a question.
Fire away.
Going back to the start of the slides where I jumped in. Apologies for being late.
All right.
Is choosing the correct investor a large reason why organizations fail? You had a list of percentages and why organizations fail. 99% lack of planning. Does the investor have a large influence on these numbers?
That's a great question. No, I'm laughing because it's a very good question. How much influence investors have over a company's decision making is different in every single company, but I will tell you that most of the time, investors let CEOs run the company, and they give advice when asked. The time when they may exert their power is in the sale of the company. Because if an investor goes in and makes decisions for the CEO, you've done a couple of things. Number one, you've given him or her a vote of no confidence. Number two, it erodes their team's confidence in them. And number three, if you want to run the company, then get off the board and be the CEO. There's a lot. Most of the best investors and mentors and advisors that I've ever had, and advisors and mentors that I know, it's like being a football coach, right? It's not just about winning the game. It's about developing the person, and their character and their ability to make those decisions. And if you step in and take too much charge of this, then you kind of neuter the role of the CEO. And good investors don't typically do that. And if you start seeing investors that want to make all the decisions, that's a big red flag.
Thank you for that. I appreciate it. That was a great explanation. Going beyond that, I was curious, do we have a source or resource to give us demographics or metrics on failures, on the failures you list? Is there any historical evidence to say failures seem to be doing X, Y, Z? In more detail, I guess.
Yeah, no. I've looked at a lot of, there's not necessarily lists or anything like that, but I've researched a ton and a ton of my own experience. Why do most startups fail? And this slide really captures it all right here. I mean, to dig any deeper, you're just going to come up with the same answers. Although there was I don't know if I should say this or not. So in San Francisco, back in the first wave of the internet, there was actually, yeah. So when the bubble burst in 2000, about 6 months later, a few people got together and started a website called Effed Company. I'll let you fill in the blank on that. And it was all about telling the stories of failure. Now, as you can imagine, unfortunately, it became a place where everybody took pot shots at each other and blamed everybody, blame the investor, blame the CEO, all that kind of stuff. But yeah, there's plenty of anecdotes about failure. But I think the number one thing that I would say is, if you're not focused on growing customer relationships and growing customer revenues, it's just a matter of time before you end up hitting a wall. And that's the number one thing that you can do. It's also the number one thing that you can do to depower the investor. So there's this whole power curve between the investor and the entrepreneur, and it should be collaborative. But there's only two pieces of leverage that an entrepreneur has over an investor. The first one is FOMO, fear of missing out, right? Because you don't want to be the investor that didn't put money into Airbnb, right? Because you're going to look like a moron. But the second thing is growing revenues, right? Because if you're growing revenues rapidly, investors will fight each other to get into your deal. And so that's the only way you can sort of turn the tables on them, because eventually you're not going to need their money anymore, because you're going to be getting enough money from your customers that you're profitable, and that will also be able to fund your growth. The only reason you need investors is because you're growing faster than your cash flows can afford to build the business to support the customers. That's the name of the game.
Thank you for that. It's a pain point for me because my family started our business in August of 2019, and I would love to blame COVID, but I would say not the right team would be the largest reason for me myself. So thank you for that.
And the other thing that I want to encourage and share is do not beat yourself up for the failures. Learn from them, but do not beat yourself up. We don't have time to talk about it on this call, but mental health is a big part of it. When we had that $30 million hole in the ground, it hurt. When I lost my company after 5 months after 9/11 happened, that hurt. My family lost money. Every investor, I pulled favors, I pulled chips, right? And I lost all of these people's money, and that hurt. In fact, I'm starting a new series on my podcast called Entrepreneurial Psychology. That's a whole different thing, but the reason I share that is because I want to encourage you, learn from them, because you'll never make that mistake again. You will very carefully choose your next team. And I'm actually one of those investors, and I know several other investors. I want to invest in your second company, not your first one, because the lessons are a lot cheaper.
And I would tell you from a personal example of a nonprofit, we launched the National Veterans Leadership Foundation in the middle of COVID, and couldn't get where we wanted to go. And so we slowed down was our answer, and waited. And we had investors that wanted to give us money to do things, but we couldn't do it because the schools were shutting down, and so we couldn't get to students. We couldn't have programs like this. And so we've taken a different approach to, it's not a hyper growth at all, but it's a different approach to, we call it crawl, walk, run, is how we're building our nonprofit. But it was really driven out of, you can't do this, you can't do this, you can't do this, coming out of COVID. And so we had to reassess completely. So it does hurt. You're right, because we knew this would work. We knew this could be a good nonprofit, and we knew we could help students like you, but we couldn't at the time, and it was painful.
Absolutely. Well, and just to begin to, as our time begins to run out here, I just want to leave one thing with you. I think we mentioned before that I did this 8-week certificate course in partnership with UC San Diego. And basically, I was giving free workshops over there to their students. UC San Diego is a big campus. They had 9 incubators. The business school has an incubator, the medical school has an incubator, the engineering school has an incubator. So I was giving workshops all over the place. And they said, well, we want to do a program for veterans. and on entrepreneurship and fundraising. Can you create an 8-week certificate course? And I was like, yeah, sure. And so we did it, and it was great. And we are exploring the possibility of making this available because it allows us to go a lot deeper on some of the topics that we talked about this evening. We outline the mission. We outline who the players are on the battlefield, who your enemies and your allies are, what are the strategic assets. And we spend a lot of time talking back and forth about this is what it looks like in a military environment. This is what it looks like in a commercial startup environment. We also look at the risk profile. One thing that those of us that are veterans are really good at is assessing risk. That's our job. And it's also a job to de-risk inherently risky environments. Well, guess what? That is the name of the game in entrepreneurship. That is actually something that gives veteran entrepreneurs a real advantage over non-veteran entrepreneurs. And I'll inject one additional thing that I think I shared with Mike earlier today. The name of the game in the hypergrowth startup world is rapid scale. How do you quickly go from 1 to 50 to 100 employees and that many customers and revenue growth? And it's really, really hard, and it's really, really messy. But when I tell my civilian colleagues what we can do in the military to stand up a unit and deploy 120 people with all of their gear and all of their shots and all their passports and paperwork and be on the ground with all of their equipment in 5 days or less, they're like blown away. How in the world do you do that? Well, I think that we veterans have a lot of fantastic experiences from our military experience that lend themselves very well to crossover. And then the tactical execution. This is something that we are very, very good at as veterans. And that's something that, quite honestly, and I'll admit it, I'm an entrepreneur and I'm great at the strategy, but I need a team around me that are great tactical executors. And that's something that veterans are very good at least the ones that I've spent time with. And what does it mean to plant the flag? As we talked about, defining the mission, defining what the obstacles are going to be, defining what resources we need in order to accomplish the mission and hit the metrics is a big part of that. So there's 8 modules in this 8-week course, and we hope to stand this up, but I just wanted to sort of throw that out as a teaser, because to your point about strategic planning, there's a lot of similarities between the military strategic planning on the left and the civilian strategic planning in the business world on the right. We all talk about mission objectives, resources, risk, tactics, milestones, what it means to accomplish the mission. It's there's a lot more in common than we realize. And so I just want to encourage you all. You have skills and experiences that are very valuable as entrepreneurs. And in some ways, you actually have advantages. And I encourage you to continue to leverage those, reach out to resources, and ask for help. And that's part of why the National Veteran Leadership Foundation exists, is to provide exactly that.
Thank everybody for spending the time tonight. I will get with JD and get the slides. I've recorded this, so you'll get a recording of it as well, and you can look back. There's a lot of great information. I've learned a ton in this, so thank you, JD, for tonight, and really appreciate your time doing this. And I hope you all realize how valuable what you're getting is, and hopefully you can use it as you're working through your projects and working with your faculty leads and figuring out what you want to do to make a difference on your campus. And then long term, how do you want to fit into this world, and what would you like to do with the rest of your life? So thanks everyone, and we'll follow up with get you to this information soon.
Thanks everybody.
Thank you. Have a good night.
Thank you.
Guys.
Thank you.
Thanks.